How can a corporation use its stock price to create shareholder value? Well, let's say that you are the CEO of a property company whose business is to rent out properties to tenants. And so you as the CEO know that each of your properties is worth $1 million. And you know this because you understand your property markets very well. You see a lot of properties very similar to yours trade, and they're all in the $1 million mark. So you're very comfortable with that number. And let's say that you own 10 of them. So you own 10 properties for a total value of $10 million. And let's say you have no other assets. So your company's only asset are the properties. At the same time, we'll assume that you took out $500,000 of mortgage debt on each property. So in total, 500,000 times 10 equals $5 million that you owe in outstanding debt, which is going to leave you with an equity value of $5 million. Assets minus your liabilities equals equity. And so we can also call this a net asset value, or NAV, or NAV. And why can we do that? Well, you can think of the $10 million as your gross asset value. But if hypothetically you were to sell that, you'd have to pay off your debt. And so the net number you'd have at the end would be this $5 million. So it's your net asset value. So I'll use equity and net asset value interchangeably in this case. And so because you are a publicly traded company, you have shares outstanding. So you have 500,000 shares outstanding. And so $5 million divided by 500,000 equals a NAV per share of $10. So that is the true value of your company. And you as the CEO are very comfortable with this value because you're very comfortable with the value of the underlying assets, which are the properties. But let's say on the other side that your stock is only trading at $8 per share. So that's trading at a discount, at a 20% discount to the net asset value. This stock price is 20% less than the true value of your company. And so why would that happen? Well, it can happen for many reasons. But let's assume that this reason is that sentiment amongst investors in the stock market is very negative right now, and so most investors would rather own real property than they would own a stock. So nobody wants to pay full value for your stock because they're concerned with short-term things like maybe market volatility or something. And so the most anyone is willing to pay for your stock is $8, and a seller is willing to sell it at $8. But you as the CEO who knows this company better than anyone and knows the value of the properties better than anyone, you really believe in this $10 value because you believe in the properties. So you notice a price inefficiency with this difference here. So is there anything you can do to take advantage of this price inefficiency? And yes, there is. You can monetize assets. And so what do I mean by that? Well, let's say that you sold 3 properties at fair market value, so at $1 million each. Well, you'd be left with $3 million, three times 1 million. And I also said that each of those properties has $500,000 in mortgage debt on it, so 500,000 times 3 homes is 1.5 million. So that would leave you with cash of $1.5 million. So now let's look at your balance sheet. Well, you still have 7 properties, and those are worth $1 million each, so you have $7 million worth of properties. And you now have cash. You have $1.5 million worth of cash for total assets of $8.5 million. And so what about debt? Well, you had $5 million of debt, but then you paid down 1.5 of it, so now you've got $3.5 million of debt, which is going to leave you with an equity value of $5 million on still a share count of 500,000. So again, that's going to leave you with a net asset value of $10 per share. So nothing has changed. No value has been created in your company just yet. But what has happened? Well, value has been realized. You realized the value of 3 of your properties, and you've proven that at least 3 of them are worth $1 million each. And now you have the cash to show for it. And so you can actually use that cash and put it to work to create value. You can go buy more undervalued homes if you want. You can start up a new business line if you want. But let's say you do something else. Well, we know that investors can buy your stock in the stock market at $8 a share. But what about you and your company? Well, your company has $1.5 million. Can they not just go into the market and buy stock at $8 a share? Well, yes, they can. And that would be called a share buyback or a stock buyback or share or stock repurchase, where you would take your $1.5 million, buy back your shares at $8 a share, and so you could buy 187,500 shares. So that's 1.5 million divided by $8. And so those shares would come back into your company, so they'd actually just be canceled out. And your initial shares of 500,000 would be reduced by the amount that you repurchased to leave you with 312,500 shares. And so now let's look at your balance sheet. Well, you still have 7 properties valued at $1 million each, so a total property value of $7 million. But now you have cash, now you have no cash. You spent your cash on buying back your stock, so you've got zero cash, and so that means you have total assets of $7 million, and your debt is still $3.5 million to give you a net asset value or equity of $3.5 million. And so wait a minute, that is lower. That's a lower net asset value than the $5 million that we had earlier. But the reason is because this net asset value is getting spread amongst a smaller number of shares. So on a per share basis, when you divide 3.5 million divided by the new share count, you get $11.20 of net asset value per share. And so what did you really do here? Well, you sold assets at fair value, and then you took those proceeds and you used them to buy back your own stock that was undervalued. So take a look at what you did. You bought low and then you sold high. And as we know, anytime you do that, you're creating value. So you just used your stock price and the inefficiencies in the pricing to create value for shareholders. Now, did all shareholders benefit? And so let's take a look at that. Let's say that I personally owned 10,000 of your shares before you did this buyback, and they were valued, the real value of them, the NAV, was $10 a share. So that left me with an investment that had a real value of $100,000. Now, we both know that the stock price thought differently, and so the stock price was $8, and the market price of my investment ended up being $80,000. So you could have argued that my investment was undervalued by $20,000 or 20%. And so when you as a company decided to buy back stock, you had to go out in the market and you had to buy it from someone. Someone had to sell you their shares. And so let's say that I was one of those investors that was very concerned about short-term volatility and didn't want to be in the stock market. And I decided that I was going to sell you all of my shares. And so I was going to sell them to you at the market price you bought them at, which means I would have received proceeds of $80,000. So no real value was created for me because we turned something that was worth $100,000 into monetizing it or paying me cash of $80,000. So actually value was you could argue was destroyed for me. So we can say that exiting shareholders, the shareholders who exited on that buyback, did not benefit. But let's say instead that I as an investor, I shared the same view as you about your company. I didn't really care about the short-term price movements of it. I just wanted to see value increase. And I decided not to sell my shares. So that means I would have kept my 10,000 shares, and they now would have been worth $11.20. And so my total investment would have been worth $112,000. So value was created for me. So what did we learn? That your continuing shareholders, the ones that stayed in the stock, they benefit. And so that's one way a publicly traded corporation can add shareholder value. When there is a price inefficiency between what they deem the true value of their stock and the market value where the stock is pricing. So hopefully this gives you some insight into how a publicly traded company can use its stock price to create shareholder value.